Excellent. So let's go through first, just an overview, and I always like to start with an overview. So the syllabus, the website, it's all up there. I think I even shot you some of the links, correct me if I'm wrong, to the websites, so you can start monitoring the markets, and you can start getting access to the graphs. I would start to monitor the markets. A lot has happened over the last 24 hours. People are freaking out, okay? And I would go ahead and get up on your computers right now and start telling me what's happening, because I'm freaking out. The market's been open for 4 hours. Last I heard, the markets were down, oil was down, gold was up, the 10-year Treasury bond price was up, and the yield was at the lowest it has been since 2012, okay? And what was happening in 2011, 10, 9, and 8? Does anybody know or remember? Yeah, financial collapse, recession, okay? Wasn't fun. So we're back to basically 2012, okay? Which wasn't fun either. Okay, so we'll see what happens. This may be the first class that I teach where I actually go through a recession and a financial crisis. So we'll see. Hold on to your hats, right? Hold on to your hats. It'll be interesting, okay? And actually your generation will be responsible to be able to managing a lot of this volatility and a lot of this risk, because you're the next generation. In 10, 20 years from now, you'll be managing corporations and managing, you'll be taking on leadership roles, and probably sooner than that. So to be able to operate and manage within a highly volatile market and markets is basically the norm. Okay, so your challenge is a little bit, your bar is a little bit higher than a lot of others. Okay, and I'll help you through that and help you through some of the intellectual capacity that you'll need to be able to manage through these types of situations. Okay, so look at me as a resource. The pre-test, which is due next Thursday, again, handwritten, show all of the diagrams. Okay, so for the normal distributions and non-normal distributions, for the box plots, stem lead, histograms, show me diagrams. Show me calculations. Show me that you understand the variance and covariance and standard deviation and correlation and mean, median, mode. Show me the calculations. Okay, draw them out for me. Same thing with the cross-sectional and time series regression. Show me a regression model. Show me the squiggly lines. Say one cross-sections in one period of time across different elements. The other one is one element or one company across time. So show me both of them, that you understand the difference between cross-section and time series. Also that you understand the difference between internal and external validity. Internal validity, obviously, from the results, but you need to talk to a lot of people internally to make sure that your model is bought off on, that it has support. If you don't have support and there's variables in the models that look counterintuitive, you're not going to get the support, and your research is probably going to be rejected. So you need both internal validity and external validity. You have to go outside of the firm. You have to ask other people outside the firm that have done research. You got to look at peer-reviewed journal articles that have been researched over time that come up with the same consistent variables every single time. So you have to have external validity too to get legitimacy. If you don't have external validity and legitimacy, you could be rejected, your research is rejected, that's it. So you have to go by the rules. Also, remember the standard deviation. There's one standard deviation calculation. The other is the portfolio standard deviation calculation. It's different than the standard deviation calculation. The portfolio standard deviation calculation is in the resources that I gave you. Just don't forget to tack on at the end of correlation or the covariance. Okay? Some people draw it out and they don't finish the equation. Okay? You got to finish the equation. Okay, so let's do this really quickly. Now that you're all fired up and you have your handhelds and you have your computers on, start telling me what the heck is going on right now, because I've been trapped in this class for almost 2 hours. The market's been moving. I need to know what's happening to the Dow. Is it up or down? By how much? Last time I heard it was down 2% and 350 points. If it hits 500 or 1,000, they're going to close the exchange down because it will have hit a circuit breaker. I heard that oil is approaching 20. Gold prices are rising significantly. They're almost about $1,200 an ounce. Bond yields on the 10-year Treasury has dropped to 1.6, the lowest since 2012, and we were coming out of a recession then. And they said that the US dollar has actually depreciated against foreign currencies. So start giving me some numbers. Validate, verify, I need some numbers, quickly.
The Dow's down
333, okay, and what is that, 2%? Yeah, and then what are we approaching 15,000? Have we broken through the 15,000 support yet?
581.
15,581, so we're really close. So if it breaks through 15,000, if you go back in time and you look at 15,000 as a support, if it breaks through that 15,000, we could see another 10% loss in the Dow. If you have a 401k, an IRA, if you're exposed to stock, your stocks are probably down 30%, so your whole portfolio could be down 40% since the first of the year. Does that matter? Yeah, because if you're going to retire, you're not going to retire. Okay, I've already lost thousands and thousands of dollars in my portfolio since the first of the year. Okay, what about oil? What about where's oil prices? And just yell it out because this is a trading.
27.
27. Okay. When was the last time it was trading at 27? I mean, it was at 30. It was at 35. When we were tracking this in my last semester class, we were at 45. Now we're at 25. 45 to 25. 55 to 25. That's 50% drop, right, in oil prices in a year. Is that a big deal? Yeah, it's a huge deal. The oil company stocks have basically collapsed, and they're continuing to fall. Russia, Saudi Arabia are running out of foreign currencies. They could default on their bonds if oil doesn't recover. Louisiana, Iowa, Michigan, some other states dominated by Houston, Texas, dominated by oil. If the oil prices go down, they could be running into municipal defaults too, and massive layoffs. So it's a big freaking deal. What about gold? Last time we looked, gold prices were up to $1,200 an ounce.
58.
1258.
Oh, sorry, 1252.
1252. Okay. How much has that gone up over the last 2 days? Can you calculate the percentage change? I want to see, because people are freaking out. They're selling their stocks. They're moving into bonds. They're selling their stocks, and they're moving into gold because they're scared. Okay. When people are scared about a recession or a financial collapse or political collapse, they move into gold. Okay. They move into gold. Can you give me some percentage changes? Can you tell me what gold prices have done per ounce over the last week? Because I want to get some momentum. I want to know where it's going because it's probably going to continue to rise if we continue to have stock market volatility. And if we continue to have oil prices dropping and taking down a lot of emerging markets. Do you have gold? Do you have gold per ounce? I need some numbers. This is the trading environment right here. I need numbers because I need to do the stuff in my brain because I got clients that want to take exposures in gold. I got clients who use gold. So I need to go long gold and I need to short gold. I need to be buying contracts, taking the appreciation. I need to make some money on the gold. So where's gold per ounce? Okay, can you tell me what it's done? Do you know how to calculate a percentage change? Can you give me a percentage change over the last 2 days and maybe the last week in gold? It's got to be up at least 1 or 2%.
Up 5% yesterday.
5% from yesterday? Is that a big move? Yeah, that's a big move. Okay, so that means that there's massive amounts of money probably flowing in, out of the stock market, flowing into the bond market, and flowing into gold. And if you see gold prices appreciate by 5% in 1 day, that's a big freaking deal. Okay, so you guys are living through history right now. You're watching history because we haven't had anything like since the first of the year. We have not experienced anything like this in the last 7 years. Okay, the last 7 years. So hold on to your hats. Where's the 10-year Treasury yield right now? The last time we looked, it was at 1.6.
It's at 1.59.
Oh my God. Okay. And then last time that we looked was that the last time it was this low was 2012, and we were coming out of a recession. So people are selling off their stocks, they're moving into bonds, driving up bond prices, driving down interest rates. So you can see where people are going right now. They're going into gold, they're going out of stocks, They're going into gold, and they're going into 10-year treasuries for safety and liquidity, okay? What's the dollar done? So this will be a reflection of global capital flows and global capital flight and global capital risk. So it has the dollar against the euro, the dollar against the pound, the dollar against the yen. Has it appreciated or depreciated? Last time we looked, less than an hour ago, it had actually been depreciating. So it's actually coming down. If the dollar is depreciating, then that means that we're probably going into a recession, okay? Because the dollar has appreciated significantly over the last 2 years. Now it's devaluing. The only reason why it'd be devaluing is because people are selling off their dollar-denominated assets and they're moving into something else because they think that we're going into a recession and the stock market's going to underperform. So the rate of return in US-dominated assets are lower now, and people are going into gold and they're going into bonds out of dollar-denominated assets. So the dollar is is depreciating. Okay, can you confirm that? Can you confirm that? If it's depreciating, then it means that it's going to cost us more to buy a pound, more to buy a euro. Okay, so if it cost me $1.13 yesterday to buy a pound, and it now costs me $1.15 or $1.17 or $1.20, then that means the dollar is depreciating because it's costing me more to buy a pound. Can you confirm that?
It's still $1.13.
It's still $1.13?
Yeah.
Okay, but it has depreciated, right?
It's been
Yeah.
appreciating.
So far this
last
week,
day,
It's in the what? Say that
Over the
again.
last day, it's been appreciating, but
It's been appreciating, or it has
appreciating.
appreciating
Yeah.
the last day, but it did depreciate since the first of the year.
Yeah.
So it is starting to come back a little bit. So maybe there's two factors that are occurring here. One, the dollar would be depreciating if there is a recession scenario. The dollar will be appreciating if there's fear, global fear, right? Because they're going to come to the U.S. and they're going to buy into dollars and go into the bond market. If you're really scared of a global recession, then you're not going to hold foreign currency. What you're going to do is you're going to convert your currency and you're going to convert into dollars, which means that there's more supply of foreign currency, which causes foreign currency to depreciate. They go into dollars, increased demand for dollars, the dollar appreciates because people are scared and they want to have their money in a safe haven. And the U.S. is the safe haven. So it could be the safe haven effect that you're witnessing. Okay? So I would say go ahead and continue to track these things. I sent you the websites. You need to start tracking these things. Okay? Because it's not like any other discipline, really, where finance and economics you can monitor on a minute-by-minute basis globally 24 hours a day. And people are doing that because we're talking about multi-trillions of dollars of transactions that are flowing across the globe instantaneously across high-speed wire, or signals, telecommunications, and money is flowing everywhere instantaneously 24 hours a day, trying to find either the best risk-adjusted return, best return, or capital flight, trying to find safety because things are starting to unwind a little bit. Okay? So I try to be as dramatic as possible on these things. Okay, so why don't we cut it?